Hello and welcome to Thompson Hine's ESOP Annual Checklist webinar. My name is Kelsey Mehaffie, and I'm a partner in Thompson Hine's Corporate Transactions and Securities Practice Group. My practice focuses on mergers and acquisitions, and I spend about half my time on traditional M&A and the other half on specialized ESOP deals, whether that be representing companies in the formations of ESOPs, representing ESOP trustee in the purchase or sale of ESOPs, or representing third-party buyers or sellers of ESOPs. We thought it would be an ideal time to do some spring cleaning and review the fundamentals of maintaining ESOPs and ESOP-owned corporations on an annual basis and explore key considerations that should remain top of mind for ESOP-owned corporations in 2024 and beyond. If you have any questions or comments, we encourage you to join the discussion by using the chat box on your control panel. We will try our best to address your comments and promise to follow up on any questions we don't get to during our time together. Today's program will be recorded and will be available to all participants early next week. We are also going to share a takeaway checklist after the call. Joining me today is David Whaley, a partner in Thompson Hine's Employee Benefits and Executive Compensation Practice Group. David, I'll let you introduce yourself and then get started.
Yeah, thanks, Kelsey. I appreciate the introduction. My name is David Whaley, for those of you that I have not actually had an opportunity to meet. I'm a partner in the Employee Benefits practice area. What that means is, opposed to the way that Kelsey sort of attacks ESOP matters from a corporate perspective, I come at them from the code or tax-based side. My practice is raised inside of the employee benefits space. It means that I'm an odd subset of tax attorney, but about half my practice is working with large publicly held, publicly traded companies with respect to their qualified, non-qualified, deferred compensation, health and welfare, executive comp, and retirement plans. And so as we look at all those natures, we end up having these issues that attack qualified plans from both a fiduciary and from a code-based perspective. The other half of my practice is inside of the ESOP space. And that work inside of the ESOP space really does drive at the fiduciary and code-based aspects of what it means to maintain an ESOP. Now, that means a lot different with respect to some of our privately held companies because there's a lot of overlay and interlay between that privately held stock on the corporate side and that privately held stock inside of the retirement plan and the code-based side from the retirement plan. So today we really want to cover some of those interesting overlays that really exist from a communication standpoint, from a procedural standpoint. And it's really important as we begin and think and work through this that an ESOP's just not a qualified plan. It is not solely a 401k plan. It is also a finance tool that's designed to transition ownership from one generation to the employees on a super tax efficient basis. And so to get that super tax efficient basis and utilize the retirement plan for that purpose, you have to do is we have to go through a lot of different check the box scenarios. We have to deliver a lot of different factors. And we have to go through this process, unfortunately, annually. And so we always like to revisit in the spring those annual processes that we're working through, trying to figure out of how do we make sure we've checked all the boxes? How do we make sure that we've communicated all the factors that we need to communicate with respect to the operation and administration of the plan to make sure we can keep being secure and comfortable in the maintenance of those tax preferred benefits for the benefit of our employees so that when they get to retirement, that they can take the benefit of the cash that the companies created to be able to give to their employees in retirement. And so the first aspect of this is really think about this as a retirement plan. As a retirement plan, there are disclosures, participant notices that we have to send out. And so we think about this sometimes from the beginning and sometimes from a different space. We have to do a summary plan description. It needs to be given to all new participants within 90 days of entry into the plan. But what's important about the summary plan description, and this is interesting, technically the Department of Labor requires that the summary plan description be updated every 5 years. Now, we have a lot of clients that try to pull forward documentation, have a little bit older documentation, but it's something to think through of when was our last SPD updated? Should we think about refreshing and rolling forward that SPD with respect to our plans, operations, processes inside of the company today? Explaining this and talking this through with a client recently, I had to point out that the pandemic was 4 years ago last month. And so if you have not updated your SPD during the pandemic time, you're probably pretty close, if not overdue, for an SPD refresh. So it's a conversation or a moment to think about, should we bring that forward? And once we bring that forward, we really need to figure out what day we want to bring it forward to. Is it beginning of 2024? Is it the beginning of 2025? And the means in which we're going to communicate that to individuals. Again, within 90 days of entry into the ESOP, realize that our new participants tend to come into the ESOP at the end of the year. So this really becomes an annual an annual event with respect to our plan for those people who are newly coming into the plan. We also have a requirement to deliver summary of material modifications within 210 days after the plan year the amendment was adopted. Now, the great thing about the SMM is that means we can deliver that SMM when we're delivering the other communications that we have to give to participants about their plan benefit. When we're telling participants how much they have in the plan, what the value of the stock is, we can roll forward and give those SMMs. Now, it's important to realize an SMM is not in every amendment that maybe happened in the past year. It's material amendments. Modifications to allocations, modifications to vesting, modifications to the ability to hold stock following termination of employment. And so those are factors we need to make sure we communicate. And I always talk with my clients that I think it's really important when we think about an SMM. It's not necessarily a question of, is it big enough as an amendment to tell people? It really becomes a question is this information we need from an HR perspective to relay to our employees? And if the answer is we need to relay this information to our employees from an HR perspective, we probably need to do an SMM. And we need to roll that SMM into the communications that we're giving to employees on a year-end basis. We also need to remember that SMM needs to be appended to any summary plan description that we give to a new participant in the future. So we make sure that we roll all those things together. If they're getting too long, might be time to think about restating the SPD and getting that all into one document. The summary annual report is within 2 months after the Form 5500 is filed. Now, interesting, the summary annual report is not the participant level statement. It is instead the plan level statement to participants. It literally is a notice that a Form 5500 annual report was filed with the Department of Labor and IRS, and here's a summary of that plan report that was filed. If there is a document that has ever found the trash can faster or more often, it is this document, unfortunately, but we still do have the requirement to deliver this document to our participant and employees with respect to the plan. But because of the timing of it, we really do try to stuff it with something else so we're not expending an extra amount of time to have it alone as a document. Also because it doesn't really detail personal communications, personal information pertaining to an individual's benefit. Instead, that's the participant statements. And in an ESOP company, that's a big day and a big factor because those participant statements are telling participants not only how many shares they have, but what the current value of those shares are. And so you're really beginning to tell them and communicate to them, hey, this is what the value is. That's the moment that you really want to think about from an ESOP as well, the means of which your company wants to engage employees, pull them forward into that employee ownership culture. I often use the example of a client that I gave a speech with that every quarter provided to their employees a one-page profit and loss statement about what was happening in the company. Because every quarter employees received a bonus both in their paycheck and into the retirement plan based on how the company was doing. They correlated that to their participant disclosures, their participant statements on an annual basis to show them how the quarterlies rolled up to make sure that the value that was being shown over the year actually resulted in increased value in their stock price. It was an attempt to get the employees to look at the profit and loss statement, figure out those aspects, those things that they could adjust at a personal employee level to grow the value. Not necessarily that everybody has to go to that level. That is above and beyond. But if we have those moments that we want to relay the increasing price of the company, we want to be able to highlight those elements that result in an increase in value of the stock. When we deliver that participant statement is the big moment to do this. And so whatever messaging goes around, whether it be written, whether it be PowerPoint, whether it be speeches pertaining to that issue, those delivery of the message of the value, you want to tie those together so that you're actually communicating to employees the tethers, the ties that are necessary to make sure you pull that value up. If we move forward, other factors that we end up having with respect to ESOP-owned companies are diversification notices and distribution notices. Now, ESOPs, as you all know, are a little bit different. They are not what we call daily valued plans. When we think of a daily valued plan, we think of our 401k plan, our Fidelity, Principal, Transamerica, Empower plan that a person has a login and they can go in and see that the market is up 128 points today. And since the market was up 128 points today, I can look tomorrow and see how my mutual funds I was invested in did. And if I were to have an event that I could take a distribution, the amount that I could take a distribution for went up. Well, ESOPs aren't that. ESOPs are what we an older school balance forward trust account. So they get valued generally once a year. And that once a year is that big moment that we deliver the participant statement to employees telling them, hey, this is how much it's gone up to. But that once a year is also the driving event with respect to diversification and distributions to those individuals that are in those pies and spaces. Now realize that diversification, unless you've modified to have a little bit more liberal earlier or even later diversification, is the right of an individual who has age 55 and has 10 years of service under the plan, 10 years of participation under the plan, to be able to move a part, 25 or 50% of the stock that's ever been allocated to their account out of stock and into another investment. Well, that other investment could be a rollover to an IRA. It could actually just be an in-service distribution. It could be a transfer to the 401k, or it could be an investment inside of a mutual fund that's within the ESOP itself. But we've got to give that notice to participants. We got to tell participants that are in that window of 55 for 6 years, 55 and 10 years of service to say, hey, do you want to diversify? Do you want to take your cash out of stock and into cash in a different investment? Now, the problem with respect to these notices, it's supposed to go out 90 days after the plan year. Oftentimes, we don't have the share value 90 days after the plan year. And so what we end up doing is we do a maybe notice to our participants. We end up indicating to people, hey, within 90 days, you're diversification eligible. You're going to have the ability to diversify 25%, 50%, whatever percent of your account. We don't know the value yet. When we get the value, we're going to come back to you and ask you if you want to diversify your account. Then when we get that updated stock price, we actually send the later notice and indicate to them, okay, now we know the stock price. You're able to diversify this dollar amount of shares. Do you want to? Please tell us within 30 days and get that back to us so we can operate with that. At that same time we're doing the diversification notices, we do distribution notices. And those distribution notices are going to be to individuals that terminated employment. Sometimes people that terminated last year, depending on our plan. Sometimes people that terminated 6 years ago, depending on our plan. Sometimes it's a continuous notice to people that have terminated a long time ago, but have not taken their distribution from the plan. So they continue to be invested within the ESOP, potentially invested within stock during that time. We need to send those notices out to participants. And as we send those notices out to participants, we're asking them, do you want your money? And as we part and parcel that money, they have to consent if that account balance is over $7,000 to be able to take the money that comes out of the plan. Now, this year, beginning in 2024, if their account balance is less than $7,000, it used to be $5,000, but if it's less than $7,000, we're allowed to distribute their account even if they don't consent. Now, it doesn't mean we can just send them their money. We still have to send them the distribution notice, because if they want their money, they can take it in a rollover to an IRA or a rollover to another qualified plan if they're covered under another qualified plan. But if they don't take their money, we're allowed to unilaterally send their money away. We need to send it to a lost participant IRA, an IRA that's set up for their benefit if it's over $1,000, but we're allowed to get rid of their money from the plan. What's the benefit of that from our perspective? It lets those individuals get out of riding the stock value. Right? So if they stay in the plan and they stay in stock, any increase next year, the year following, they're going to get the increase of that stock value. So we may very well want to facilitate and force those individuals with the accounts that are less than $7,000 out of the plan. We may even want to have a conversation pertaining to individuals that have more than $7,000 and getting them out of stock. Different conversation, different session, but this is the time we look at those crowds. Who's terminated? Who is able to take a distribution, who has taken a distribution, and those people that haven't taken a distribution, do we want to address their investments in some means? And then finally, required minimum distributions. Very, very rarely do we see required minimum distributions as a challenge or a problem for any ESOP, largely because we start distributions usually before individuals hit the required beginning date and get the money cleared before that point. But if we do have individuals that are in that space of that age, we need to make sure we understand and do pay attention to the required minimum distributions that are required to go out. Your record keeper should be able to assist you with that. We can move forward. Okay, annual checklist with the Department of Labor. Those were our participant notices. Now we have to figure out what we're going to tell the Department of Labor, the IRS. We have a Form 5500 report that's due 7 months after the plan year. So for a calendar year, that's July. It's extended for 2.5 months if you file the extension, the 5558, by that's July 31st. It's automatically extended to the due date of your tax return if your corporation files an extension for their tax return. Now, one of our catches or questions here, your tax return may be due but maybe actually due before the longer extension that you get for the 8955, for the 5558 extension. So we encourage all of our employers to go ahead and file the 5558 extension if they're not going to file by July 31st. Many of our plans do not file by July 31st because our primary focus is really first getting that value before we turn to getting the 5500 filed. And then something to make sure we pay attention to and make sure that we're on top of is the 8955 SSA. Those are due 3 business days before the 5500 deadline. So if we have an extended deadline to before that deadline, the challenge we have with this is actually telling the Social Security Administration, people who we have vested benefits, but we have not yet paid. And then we have to tell them when we do pay those vested benefits to those individuals. The reason why we need to make sure this is correct is if we get a mismatch with respect to what we report to SSA, we're very likely to get ding letters from the Social Security that basically go to the employee participants, former employees, and it says to those former employees, you may have money inside of ABC ESOP. And those notices will go out incorrectly often if we mess up our 89 and 55 SSAs. And so we want to make sure we get them as right as possible going in to make sure that we're not 10, 12, 15 years later, literally 25 years later in one of the matters I work with, having to communicate with people saying, nope, we did this, you don't have a benefit, because we're trying to prove the negative of an individual who does not have a benefit whenever those notices from SSA go out. We can slide forward. So again, the annual reports. Anything that we've paid from the prior year, we've got to push on a Form 1099-R. That's telling the IRS, hey, we paid this out. And we need to make sure those are right. We paid it out in a direct rollover. We paid it out in a lump sum distribution to the individual. So let's make sure we get those right. We mail those to the participants. Form 1096 rolls up all those 1099-Rs and send them to the IRS. And a Form 945 is for any tax withholdings on distributions that were paid. Again, that's not necessary if there are no taxes withheld on distributions paid, but if we're paying cash, we probably have some withholding requirements that we're otherwise going to have to cover. Now, if we move forward, one of the things we wanted to talk about a little bit more this year, we talked some about in the past about the finance annual checklist, things you have to think about by being an ESOP. But we're seeing a lot more companies think about this, what you need to think about by being an ESOP in the nature or context of some of the sustainability aspects of being an ESOP. So we're going to work into those. But again, annually, what do we have to do? We have to update our projections. So the officers are going to report to the board, and the board's going to approve a set of projections for the next 3 to 5 years. So the trustee and the trustee's valuation advisor can value our company. Remember, our historical aspect of what we've done is only an indicator of what we're going to do. And so what we've done is usually not enough to get our value. We're going to have to help the trustee, help their evaluator, and tell them we think we're doing X, Y, or Z into the future. We have to update our projections. We really believe those projections should be a bottom-up, not a top-down scenario, and they shouldn't be goals. They shouldn't also be layups. They should be what we really believe we're going to achieve in a garden variety 100% down the middle of the year. Now, very rarely will we hit our projections. We are usually either over or under our projections. So we are going to have some missing between the two, but we want to make sure that we're not just putting out hopes to our valuation advisor, because if we do, we're going to end up with too high of a value and concern on the part of the trustee for us always missing. We also want to put up those layups because then we're going to have too low of a value, and we're also going to have concerns that the trustee's trying to figure out how to value our stock. So we want to make sure we're trying to get down the middle. We want to review the annual evaluation as it comes back from the trustee. Why do we want to review it? We want to make sure it's not stated upon facts that are just incorrect. So if what happens whenever that comes back to the board from the trustee is if it turns out that the projections we gave them had the wrong CapEx number. And so therefore, when we actually input the incorrect CapEx number for this year and for the next 5 years into our projections, our value changes up or down. We need to make sure they understand and can tell that story with respect to what's happening. So that's one. One of the other reasons we want to look at that valuation, we want to make sure that the metrics that they're utilizing are really good comparisons. They're going to compare your company to other competitors in the marketplace. We want to make sure that those comparisons are the correct ideas of what we are. Maybe we're not, from our valuation firm, seen as a tech company, and we think we have morphed into a tech company. So we think our multiples are in a different space because we have really leaned in to the utilization of machine learning and artificial intelligence. And we really see ourselves as a tech company now, not a general service company. Those are thoughts we need to express and see if they're kept within the valuation. The other reason we want to see inside that valuation is because we want to understand what our value looks like in a waterfall. Why? Because there's a chance, and especially in this market right now, I was watching Bloomberg this morning, and they had another analyst that was saying that we are in the space of another 12, 18, 24 months of a ton of merger and acquisition activity, meaning that companies are going to look to buy companies. And we may be among those companies that companies are looking to buy. And we need to understand what our value is. More than understanding we're $172 a share, understanding that at $172 a share, how that waterfalls among warrant holders, how that waterfalls among SARs, how that waterfalls among unallocated shares. So we can figure out what number would even be a conversation to begin having that conversation with a potential suitor. That leads us to the other part. If we are seeing enough marketing activity at us, more than just business brokers calling the CEO and saying we'd like to buy your company, but true market activity coming at us, we may very well want to adopt an unsolicited offer policy. And we want to adopt that so we actually give the ability to the officers of the company, the CFO, the CEO, the president, to be able to literally look at offers and go, yeah, it looks like a decent offer, but we're not going to entertain it because it's not high enough. Looks like a decent offer, but we're not going to entertain it because the buyer's not able to buy us. We get an offer from a competitor and we realize that it's not a high enough number. And all that's happening is the competitor is trying to keep us off our game and to try to get our information despite having a non-disclosure and non-solicit agreement with us. So we want to be able to protect our officers from rejecting some of those offers, but also provide the framework by when our officers need to say, goodness, this offer looks sufficient. We need to move forward with respect to actually having a conversation. Let's push this up to the board so the board can consider. So you may want to, if you're inside of that space, really try to figure out, do we need an unsolicited offer policy? And what's our number from our implied value that we would actually need to begin those conversations in earnest? We want to review our covenants from our bank documents. Very often inside of ESOP formation transactions, and even not in formation transactions, we have term debt, we have revolving debt. We're going to have covenants with our bank that we demonstrate what we need to keep within from our profitability and revenue compliance standards to make sure that we are not in violation of those documents. We need to make sure we understand what those covenants are and that we're complying with those covenants. We need to consider going back to market on our bank loan. If we have a term bank loan, is it the right time to go talk to the market to get cheaper debt, more debt, longer debt? And that's part and parcel of the company's thought with respect to looking at over the next year. Hey, what are we thinking about? And then finally, those first year ESOPs, right? So we're a year, maybe 2 years after the deal. We need to look at the post-closing deliveries and covenants from the SBA. Have we dealt with the net working capital adjustment? Have we delivered the annual financials to the trustee as required, or even the bank as required? Have our compensation limits and the projections been modified because we've had, in the past couple of years, we've had some significant increases in those limitations due to increases from inflation. So let's look at the way that those work inside of our projections to see if we need to make some modifications because we're a new ESOP. We're trying to figure this out. And then realize for 1042 ESOPs, maybe there's a chance of this year or in the year you're in to move from a C Corp to an S Corp. And that's really important because realize that S Corp ESOP is sort of a tax nirvana space, right? A K1 that flows to a tax-free trust that doesn't pay any taxes. So we want to make sure we don't miss the opportunity at the beginning of the year to make that election. If we go to the next slide. And then as I noted, these sustainability aspects, things that we're beginning to really dig into and understand with respect to ESOP-owned companies and how important it is. Because the challenge with respect to an ESOP is that it's not just getting through that first part of trying to say, hey, we own stock inside the company. It's actually the other aspect of how do we have generations of individuals roll through this plan so that we can actually turn a profit to make sure that people can retire. Though you say this often, and we talk about it a lot, you can't retire from a privately held company with a stock certificate. I might have been allocated 472 shares of ABC company, but if I get a stock certificate and go to Kroger to try to buy groceries, I'm going to have a hard time getting groceries from Kroger for that stock certificate. Instead, the company's got to turn that stock certificate into cash. And they use the current valuation and the cash flows of the company to turn that stock certificate into cash. What we do, how we generate that cash to be able to pay for the stock for the retired individuals is a question for that sustainability and repurchase obligation. Then in addition, what we do with those shares, those 492 shares in my example that we just bought, it really becomes a question of our long-term future to make sure we have enough shares to give to employees now and down the road. So we have to think about that balance from a sustainability standpoint. So what makes an ESOP sustainable? The company's able to afford the ESOP cash requirements. It's able to make sure that whenever that person walks out with the shares, it can turn those shares to cash. And it doesn't bankrupt the company to turn those shares to cash. It also doesn't stretch the capital expenditure needs of the company to turn those shares to cash. right? And then on top of which that it's a long-term benefit for the ESOP participants. And that's not only the current participants. That's the person that's walking in the next year and next 3 years, next 5 years, because the ability of the company to be able to be sustained for the long term includes the ability of the company to be able to hire people down the road to fill the jobs of those people that are retiring down the road. Now, why this matters now? Unfortunately, we do have a set of litigation, and we have a good amount of litigation in the ESOP world. We all understand that. We've dealt with that. Specifically, in the past year, there was a lawsuit filed pertaining to what we call a re-leverage transaction. The re-leverage transaction was a company had a large amount of shares for retirees that they bought back. And then they sold those shares to the ESOP so that next generations could take those shares for their retirement benefit. The lawsuit, we're going to call it not very well founded, but still exists, saying that since you bought the shares that you just bought back from the ESOP and you ESOP owned 100% of the shares, you violated your fiduciary duties. There's no way if you own 100% of the shares, you can actually buy more shares. We find this entire thinking incorrect. We've actually advised, I'm sure, people on this call with respect to re-leverage transactions. But the baseline of this comes down to the real question we began in the community is, if you're doing a re-leverage transaction, the question is why? You're doing a re-leverage transaction because of the sustainability and repurchase obligations. You're trying to manage both of those so that our repurchase obligations don't shoot the roof, so that we can make sure we have enough cash to be able to pay people so they can go to Kroger to buy groceries, and to make sure that we have enough shares to give to new employees so that they can fill the jobs of the people who just left to go buy groceries. So if we can go to the next slide. We like to think of sustainability and repurchase obligations sort of three tranches. First 5 to 10 years, the new ESOP. Your number one use of cash in that time is paying off your ESOP transaction financing, right? It's paying off your seller debt. So we don't think about it a ton in that window. We're really just trying to pay down debt. 10 to 15 years, we all of a sudden see that repurchase obligation increase. The share price is totally recovered from the debt load. So we're also starting to see some people who may be walking out of the company with pretty significant share account balances that have pretty significant value. We're now starting to see an outflow of cash from the company. Have we saved? Do we need to save to pay those off? And then we get into mature ESOPs, 15 to 20 years, more years down the road. We're seeing a lot more individuals, and we start to see some lumpiness to this, some different pockets of individuals who have large accounts who all may be leaving in the same windows. We have to think about all of that as we're looking at our sustainability and repurchase obligation to figure out how we want to handle those tools. Now, if we go to the next slide, so realize we talked about this. There's a duty to buy back the shares from an ESOP participants due to their termination or diversification election. So let's think about it from those perspectives. And a large ESOP repurchase obligation may mean that to get the money into the plan to facilitate that, we're going to exceed the cash that we have. So we might need to talk to a bank about borrowing. To get the money into the ESOP, we may actually exceed the annual contribution levels to the plan. We only allowed to put 25% of payroll into the plan. Or we may actually exceed the 415 limits, the number of the annual bucket for each participant. So as we think about and go through that, we can't trip up on a sustainability issue in year one. We've got to start thinking about it from at the beginning, not necessarily year one of the ESOP, but maybe year 4, 5, 6, we start to see those larger account balances. We need to start thinking about where is our cash going to come from. Then in years 10, we need to start thinking about, okay, our cash is coming from there. When are our lumpy years going to happen? And how do we deal with that? And then as we start buying back a good number of shares, we need to think about where are we going to have shares for the people in the future, for our new employees into the future. So those are really the thoughts we have to think about as we look at this. And if we go to the final slide of the sustainability set here, it's important to think about is that it's not necessarily the amount of the loan going in. It's the amount of the shares coming out that we really want to be careful of and make sure we are really impacting the employee workforce with, right? Because we may have a very low loan 20 years down the road that's going to release a lot of shares of value. And we need to be careful and cognizant that maybe that's even allowed and legal with respect to the metrics that we have underneath testing. But are we overcompensating our employees at the expense of future employees with respect to that? So we want to make sure we're looking at the value of stock that's going to fall down to participants from their contributions, the value of stock that's going to go from reallocated forfeitures, and the value of stock that's coming in from ESOP loan suspense. Make sure that that value is in a sustainable level, but also a sufficient level to let us attract and retain quality employees. So we have a good employee benefit, but not too much of an employee benefit that we're not going to be able to pay off the crowd that's retiring, and not too much of a benefit or too little of a benefit, both, that we don't have shares left over for the next generation to run. That balancing act, that sustainability and repurchase obligation, we're seeing that boards need to take that on, mature ESOP boards. So we're talking 10 years plus of ESOPs need to take that on an annual level to make sure that the board is reviewing, dealing with, and addressing sustainability and repurchase obligations. So if they have to go that releveraging route, they have the workflow to demonstrate to the trustee and to the fiduciaries, this is in the best interest of our company. So we think of that now as an annual task with respect to our more mature ESOPs. And honestly, with respect to our clients, happy to at some point get on a call and talk through and walk more through that. Now, Kelsey's going to move forward with respect to some corporate annual checklist that we end up seeing that companies have to, ESOP-owned companies need to run through on an annual basis. Kelsey.
Thanks, David. So David talked through all of the annual requirements for ESOPs on the benefits side and a little bit on the finance side. Now we're going to pivot and I'm going to talk about some more corporate and commercial items, and then we'll get into a little bit of employment and real estate items as well. First, we're going to talk about corporate annual items for first year ESOPs, because this first year is going to be a year of adjustment. And for any first year ESOPs we have on the line, I'd invite you to think back to everything that you negotiated in the term sheet, all that back and forth with the trustee in that negotiation, and all of those items that ended up in the purchase agreement as covenants or promises you made post-closing for how you would adopt certain governance changes. When we think back to that negotiation with the trustee and stepping into the trustee's shoes, they want to see you moving from, a privately held company, maybe owned by family or really closely held, and having governance standards that were appropriate for that privately held company, into something with a little bit more of a formalized governance system and formal governance practices on the corporate side. The reason for this is that the trustee needs to show control under regulations applicable to ESOP-owned corporations. So that's where the trustee's head is at in these in the term sheet negotiation, resulting in the requirements that you're going to have to comply with post-closing. And like I said, the first year is a year of adjustment as you're trying to figure out all of these new corporate governance structures that you have to adopt. This might also be a change for you because prior to the ESOP transaction, your company might have been a limited liability company rather than a corporation. And if we handled a reorganization for your company in that ESOP transaction, you'll know that we discussed that ESOPs have to be primarily invested in corporate stock. So at this point, LLCs are not able to be sold to an ESOP. And so many of the changes that you might be facing in the first year might stem also from that transition from a limited liability company into a corporation. And those changes are driven more by state law rather than the negotiation with the trustee. So there's a lot of change going on in that first year. The first is that you probably remember in the term sheet that you agreed to adopt a nomination and compensation committee in most cases, and in some cases an audit committee. And you may not have had any committees of your board of directors prior to the ESOP transaction. You may not have even had a formal board structure prior to the ESOP transaction. So that will be one thing you'll need to implement. What the nomination committee does is it evaluates candidates to the board and nominates those candidates to the board to the ESOP trustee so that the trustee can vote on board of directors members as the shareholder of the company. The compensation committee is going to usually determine the compensation of the selling shareholders in the ESOP transaction and monitor the SAR plan, which you probably adopted in your ESOP transaction. You might also have a plan administrative committee, which is more on the benefits side, but it's another layer of a committee that makes recommendations to the ESOP trustee on voting for directors. So in order to put these committees in place, the first step is that your bylaws will need amended if we didn't amend them at the time of the closing in order to provide for these committees. And in order to amend your bylaws, it depends on what the bylaws say, but you might need board or shareholder consent. And then in the form of a board consent, we would actually adopt the nomination and compensation committee and any other committee that was required. And the board would approve that, and the board would also approve the members of those committees. You're also going to be holding annual shareholder board and committee meetings. And one thing you may remember from the term sheet negotiation was that you negotiated a total number of board members and a certain number of independent board members. You also negotiated the definition of independent. So as you're going back and trying to identify who is going to be our independent director, and trying to hit that post-closing deadline, you're going to want to look back at the purchase agreement to make sure you're working within that definition of independence. What it normally boils down to is someone who's not a seller, not a current or former employee of the company, not a current or former service provider to the company, and that might have a certain dollar threshold that applies or a certain time period looking backward from the time of appointment that applies, or family members of those individuals. So what you'll end up with on your board is a mix of probably the selling shareholders, maybe some people from management, and then a specific number of independent directors that you would look to your purchase agreement to figure out what that number is. The trustee's role in identifying these independent board members is really sort of blessing them after the board, through the nomination committee, has made that recommendation. So typically it will be someone that you know in your industry, maybe someone who's involved in the ESOP community that you've identified. And then you will provide the trustee with their resume, perhaps offer the trustee a chance to meet with them and talk to them. And the trustee usually will defer to the person that you've identified so long as there are no red flags or anything like that. So the company really is driving that selection process, but in order for the trustee to retain control, the trustee has to sort of bless that person. So one other thing about the annual shareholder board and committee meetings is that this is one item that's driven by state corporate law. So if you're coming from an LLC, this will be a change for you since LLCs don't have to meet annually and hold those meetings. Next slide. So after the first year, as an ESOP, you've gone through this one time before, and now you're thinking, what do I have to do on an annual basis to maintain this? Since you're a corporation, like I mentioned, annually, you're going to have to appoint your nomination, compensation, and other committee members. If they stay the same, you're just going to be affirming that same slate. And then also annually, you're going to need to hold those shareholder board and committee meetings. Under state law, this is, like I mentioned, something that's different for corporations as compared to limited liability companies. So this isn't necessarily an ESOP-driven requirement, but it probably is a requirement in your purchase agreement to hold annual shareholder meetings and re-elect the board each year. That's just sort of a double layer protection for the trustee to make sure that you're complying with those control requirements, but also just state law required of corporations. The board will elect the officers of the corporation. Under state law, that's something that also has to happen on an annual basis. In most states, you're going to have to elect a president, secretary, and treasurer. So those are annually the required officers that you should be electing. You can have officers beyond that group of three, but those are the three that in most states you'll need to have. In some states, those required officers can vary, and sometimes it's a similar concept of that officer, but has a slightly different name, like maybe they will call president chief executive officer or treasurer chief financial officer. So that depends on a state-by-state basis. And then on an annual basis, the board is also going to have responsibility for monitoring the engagement of the trustee. And so they're going to think about, do we want to continue to engage this trustee? Is this trustee meeting the requirements of what we think our trustee should be doing? And should we keep this trustee on board? Or is there something that's gone so wrong that we're thinking about removing the trustee? And that's something that the board would determine. And in that way, even though the trustee is the shareholder of the corporation and has that control over electing the board, the trustee is also sort of like a third-party vendor where we can continue to engage the trustee or we can remove them. On the ESOP required steps on an annual basis, so at closing, there was a stock certificate issued to the ESOP trustee to the trust to reflect ownership of whatever percent of the shares that the trustee bought. You might also remember that as a part of the transaction, your corporation made a loan to the ESOP to enable the ESOP to buy shares. The shares that were purchased by the ESOP were pledged as collateral on that loan between the corporation and the ESOP. The corporation then makes contributions to the ESOP annually, and the ESOP uses those funds from the contribution to pay off that internal loan. As the ESOP pays off that loan, the shares proportionate to the amount that's been paid are released from the pledge and are no longer collateral under the loan. That release means that those shares can be allocated to participant accounts. And so each year you should be tracking how many shares have been released from the pledge and allocated to accounts. And you should also be issuing a new certificate, one for allocated shares, one for unallocated shares, and you should be updating your stock ledger as well. Next slide. So this is a visual here, sort of showing the circular governance structure that I was talking about earlier, and that balance between the ESOP trustee being sort of a third-party vendor in a way that the board can engage or remove, but also the shareholder of the corporation that needs to exhibit some control over the corporation. So if you look in the lower left corner, this is showing the trustee in their capacity as more of that third-party vendor. The board of directors can hire and engage the trustee, can remove the trustee, and monitors the trustee's work. The board of directors also appoints the members of the nomination committee, and that nomination committee is the group that delivers the slate of directors to the ESOP trustee as shareholder. And like I mentioned, they sort of drive the selection process there. The ESOP trustee then has to, as the shareholder, elect the board, and the board of directors appoint the officers select managers, and the managers hire the employees. And all of those people might have interaction in one way or another with the ESOP, and maintaining the day-to-day. And so next slide. Thinking of your ESOP-owned company just as a corporation, these are some of the annual items to think about, regardless of whether you are owned by an ESOP or not. The first item is that you might have subsidiaries that are LLCs, or if we did a reorganization for you where a holding corporation was put over the top of your existing LLC and that LLC continues to exist as a limited liability company. The great thing is that LLCs offer a lot of flexibility on the corporate governance side. They're more governed by the operating agreement, and in that way, they're more so creatures of contract than state law. And you can really control and draft your operating agreement in a way to require whatever you want. The main thing is that in most states, there are no requirements for LLCs to re-elect the same officers or managers on an annual basis. So for your LLCs that you have in your corporate structure, there's no need for you to re-elect officers or managers annually if there have been no changes. If you do have changes in the managers of your LLC or the officers, or if something really material happens, some sort of extraordinary event like taking out a bank loan or purchasing real estate, something really extraordinary, then those things should be approved by the LLC. But on an annual basis, if you have no changes and if there are no sort of extraordinary events, there's no need to have that annual approval process, which makes LLCs a lot easier to maintain from a governance perspective. Another thing to think about is filing annual reports with secretaries of state in all jurisdictions. So not only the jurisdiction where you are incorporated or organized, but any jurisdiction where you are qualified as a foreign entity. So if you are incorporated in Ohio, but you do sufficient business in Indiana and Kentucky that you need to qualify there, you're going to want to be tracking your annual requirements not only in Ohio, but also Indiana and Kentucky. And most of the time that will include filing annual reports. And on an annual basis, you're probably going to want to think about, do we still need to be qualified in this state? Because there is a bit of administrative burden in being qualified in states where you don't need to be. So if you've ceased doing business in Indiana, in my example, then it should be time to withdraw in Indiana and consider, not needing to track that state anymore, not needing to make any annual reports or other updates there. You should also be looking at your other Secretary of State registrations that might expire. So for example, in Ohio, you can register a trade name if you incorporate under your full name, but you do business under a shorter version of your company's name. You might want to register that trade name. Trade names in Ohio expire after 5 years. So whenever you file that trade name, you should put a reminder on the calendar for 5 years down the road so that you remember to renew that trade name and keep it registered in Ohio. You should also be checking your registered agent for service of process annually and making sure that's up to date. Your registered agent can be a person, so as long as they're located in the state, it could be an individual at your company. You can also hire a third-party service provider that will serve as your agent for a fee. And this is really important to make sure it's updated, because if you are served with process and made a party to a lawsuit, you really want to make sure that the person receiving that service of process is someone who's reliable, that you have their correct address, they're still with the company, or you still have them engaged as your third-party service provider. Otherwise, you won't get proper notice of your suit, which could go wrong quickly. And then you also want to check all of your business licenses for renewals and necessary updates. Next slide. Okay, now we get into a new requirement for this year. The Corporate Transparency Act was enacted in 2021, but it went into effect in January of this year. The purpose is to enhance transparency in entity structures to combat money laundering, tax fraud, and other illicit activities. It requires companies to report beneficial owners to the Financial Crimes Enforcement Network of the Department of the Treasury, also known as FinCEN. So there are some deadlines approaching and some that are new for this year. The deadline for beneficial ownership reporting to FinCEN is this December for any entities that were formed 2023 and earlier. For any entities formed in 2024, the deadline is 90 days after formation or after becoming non-exempt. And for entities formed 2025 and later, the deadline is going to be 30 days after formation or becoming non-exempt. And there's also a deadline if there are any changes in beneficial owners, you must report 30 days after that change occurs. So not all entities have to report. There's a long list of exemptions from the CTA, and we won't dig into all of them in this presentation. But entities that meet all of the following criteria, which is referred to as the large operating company exemption, will be exempt from reporting under the CTA. So if you have 20 employees or more, at least 5 million in revenues or sales reported on a federal tax return for the prior year, including revenues from subsidiaries, and a physical operating location in the US, then you're exempt from CTA reporting. There are other exemptions, but this is expected to be common, like I said, and just be careful of holding company structures. This is where this exemption can quickly become inapplicable, mainly because of that 20 employee requirement. So if you think back to your reorganization, if we helped you with that in connection with your ESOP transaction, we may have put in place a holding company, and that holding company may hit the second two requirements of this exemption of having 5 million in revenues, including subsidiaries, and also having that physical presence in the US, but it might not meet the requirement to have 20 employees or more. And if we go on to the next slide. So what has to be reported under the CTA? It's your beneficial owners. And those are people who exercise substantial control over the entity. This expressly includes CEO, president, CFO, COO, general counsel, and others performing similar functions regardless of their title, and members of the board of directors. It also includes individuals who own or control 25% or more of the ownership interest of the entity, and that includes warrants in that calculation. Warrants are very often issued in ESOP transactions, so that's something to be on the lookout for as well if you find that you're not exempt and you're trying to figure out who needs to report. The reportable information in FinCEN's portal is the name, date of birth, address, and your ID number from an acceptable document, which are things like your driver's license or passport. And you can also obtain a unique FinCEN ID number instead of providing all of that individual information. There are penalties for providing false information or for failing to provide required information. For false information, it's a $10,000 fine. And for failing to provide information, it's $500 per day. So those fines can add up quickly.
So we have a question just to make sure that there had been a report that a judge ruled the CTA unconstitutional and it put a pause on the reporting. One of the things I think that's important for us to really sort of pay attention to, we're telling our clients, there is a due date at the end of this year for a lot of existing companies. We do believe that that's probably going to be extended. We're really sort of telling people, let's wait till the second half of the year, see how this all shakes out, the litigation notwithstanding. But for our newly formed corporations, we are having them go ahead and go ahead and make the filings with FinCEN as necessary, because the application of that, is my understanding, is very, very particular, depending on some Supreme Court litigation, actually, about the ability to have and utilize sort of one district for whole country injunctions. And so we think that the potential penalty, and honestly, the challenge of filing is so minimal, annoying, but not terribly challenging, that it's worthwhile for our new companies that are forming holding companies to file. The due date with respect to the future, I'm going to guess it gets pushed, but we don't quite know. We're paying attention until the second half of this year to figure that out. Kelsey, anything you have with respect to the CTA in that space?
Yeah, and I will note that David and I recently authored an article on how CTA reporting might specifically impact ESOP-owned corporations, and we will circulate that. Also, our CTA working group, who has been digging into all the regulations and staying up to date on everything, also put out an article on the unconstitutional ruling, and we're happy to circulate that as well, but they've sort of written on that topic too. So now moving to the commercial items. One thing you're going to want to do, and this is really focused on your contracts that you may have with vendors or customers, and keeping track of all those items on an annual basis. You're going to want to annually review your vendor and customer contracts for expirations and renew as required or desired. You're going to want to track two pieces here. The first is the date that the contract expires, and the second is any advance notice timelines where you might have to provide 30, 90 days notice of intent not to renew or intent to renew. So those are things to keep an eye on. You also want to use renewals as an opportunity to update the terms of your agreements if you've developed more standard or preferred terms in a certain area. Those renewal amendments can be a good time to amend other aspects of the agreement as well. For internal purposes, you might also want to collect your preferences and create a checklist of standard terms. So this could be insurance requirements that you very often have to fill into agreements, preferred limitations on the warranties you're giving, limitations of liability, and any indemnification provisions. So if there's anything you've been burnt on in the past and you want to change that practice moving forward, you can create a checklist and use those renewals as an opportunity to change things. It's also great to create a central repository with signed copies of all of your contracts. One reason is so that you can be tracking all of these provisions, knowing what the requirements are, knowing when things expire. The other reason is, like David said, in this upcoming M&A environment, if the company needs to sell it, it's really nice in loading that initial data room to have all of your contracts handy. So that's one reason to have everything on hand. You might also want to consider training your sales representatives. They're on the front lines and very often might not know to look to the checklist or reach out to someone in particular if they have a question. And so you want to teach them things like avoid just clicking yes to accept counterparty terms and exposing the company potentially to some risk there of terms that haven't been read through or thought about. And you also want to educate them on when to use your paper versus when it's okay to use customer or vendor paper. Next slide. And then a few labor and employment items from our labor and employment specialists. On an annual basis, you're going to want to confirm that your employee handbook and your policies are up to date. You're also going to want to confirm that your practices are consistent with wage and hour requirements, and that you're paying the required minimum hourly rate or salary in each state. On an annual basis, you might also want to confirm that your independent contractors are meeting the applicable tests to be properly classified as 1099s rather than employees. And our labor and employment group has a great process for pushing out all of these updates in state law and keeping you up to date. We have a link here that will circulate to our employment legislation outlook, so that will be circulated after the presentation. Next slide. And lastly, some annual real estate items. When it comes to your leases, similar to your annual contract monitoring, you're going to want to review for upcoming deadlines and for renewal or early termination rights or rights of first offer. If your lease is expiring this year, you're going to want to engage with your landlord or a broker to think about renewal rights. And if you don't intend to stay, you should review your obligations on vacating in case there's an inspection or an obligation to remove improvements. You also want to review your insurance coverage to make sure you're in compliance with those lease requirements. And on owned property, you're going to want to continue to review your property condition and capital expenditure needs, and then also think about tax appeals of the valuation of your real estate, which was recently a big issue in Ohio with all the updates that came out in the fall. And that is our last slide. And we're nearly out of time, so that concludes today's discussion. We're happy to take any questions if you'd like to enter those in the chat box now. I don't think we got any additional questions.
Kelsey, we got a question pertaining to the FinCEN, and honestly, I wanted to make sure they turn a little bit more to the communication that we'll send out, but it's really pertaining to an ESOP-owned company and the fact that we're going to have a broad crowd. If you have a holding company and an ESOP-owned company, the individuals that are going to have to file as a beneficial owner, that really ends up falling to them as the beneficial owner more than the company, right?
It's actually the company that's
It's the
responsible.
company that, so the company has to gather that information for the crowds of individuals, and then they file
Yes.
with respect. Okay, so that's how I was thinking of that in the backwards. So yeah, so it really is the company that gathers that information and ends up dealing with it. And we're still, and a lot of this is super interesting, is that we're trying to figure out how this goes. I've heard an estimate that there's 38 million filings that are going to have to go in, which is, I do believe, would be the second highest number of filings going into the federal government behind 1040s. One minor change to FAFSA, as FAFSA is still not going in for newly enrolled students. So this one's going to be a challenge to see how it actually comes to fruition. So we will learn more, and my guess is that it's going to be a challenging 4 to 5 year period before it actually gets to a level set that we don't think much of it. And then we'll get to the point at which we don't think much of it.
And David, we had one more question about whether an ESOP can have more than one trustee.
Yeah, you definitely, I mean, so with respect to having more than one trustee, you can, but there's two ways in which we have more than one trustee for any qualified retirement plan. One way is that we have two separate pots. We'll have plans that have their 401k and their ESOP in the same plan, and we'll have a trustee that handles the elective deferral, basically the non-stock portion of the plan, so the mutual fund aspect, and a trustee that handles the stock portion of the plan. Right. So in that world, you have two trustees that have direct, distinct areas that they are governing, and they have the full ability with respect to the area that they govern. We also have worlds in which we would have multiple trustees serving over a singular pot. So let's say the stock fund is by a panel of trustees. In that scenario, which you sort of have a trustee by committee scenario, it's not unusual. We need to be very clear how actions are taken with respect to that panel of trustees. And so we like to see at that standard that the trust engagement or a separate charter with respect to that trust committee really detail. Is it majority action? Does the authority of one party of the trustee have the authority to bind all the trustees, or do you need all the trustees on a signature block? So we really want to make sure, hey, how does that trustee take and make actions, and how is it demonstrated to all the other counterparties? So yes, legal to do that committee approach can become a little bit more challenging to make sure we understand how it works and we document how it works.
And then we had another question. Yes, we will be providing the presentation that will come out next week with a few other materials. And then one additional question about whether individuals can apply for their own FinCEN number. That is correct. That's the unique FinCEN identifier that I referred to on the second CTA slide. And I think that's it. So thanks everyone for joining. As mentioned, this webinar was recorded and will be available to view in our library of recordings on Thompson Hine's YouTube channel. Make sure you visit the page and hit the subscribe button to stay up to date on all of our content. The recording will also be sent out early next week to all attendees, and we will be sharing a takeaway checklist in some of the articles we mentioned after the call. Thank you all for attending today's program, and please don't hesitate to reach out with any questions. Thank you.